People often ask me, is there a backdoor way to get a lower mortgage rate? And I get it. Rates been pretty high the past few years, and we got used to these 2 and 3% rates, and now rates are quite a bit higher, and people are frustrated, and I get it. And you want to know what are some legal backdoor ways to get a lower interest rate. And so today I'm going to talk about one of several different methods you can use. But this is an easy one to do, one that's easy to qualify for, and it's called a temporary rate buy down. And so temporary rate buy down is exactly what you think it is. It is a a buy down where you will get a lower interest rate for a set period of time. Before I dive deeper into this video, though, I want to mention that this is for example purposes only. This is not an offer to lend. Rates and terms may vary. My compliance guy wants me to tell you that. So we certainly don't want to get in trouble with compliance. So there we go. We're going to flash it 3 or 4 times across the screen. But these are example purposes only. Rates and terms may vary, but this is a legitimate strategy. All right. So, like I said, it is for a set period of time. And I like to call it similar to a teaser rate on credit card. That's probably the easiest way to explain these. You see these credit card offers all the time where, Citibank or whoever says, oh, yeah, for the first year or whatever, you'll get this rate. Might be a 0, might be 10, might be 9, might be whatever. And then after that certain period of time, you'll get a higher rate. So I like you to think of it kind of that way. That's a teaser rate, but for a mortgage. And people don't realize you can do a teaser rate on a mortgage. And there are different types of buy downs. And so we got your 1.0 buy down, got a 2-point buy down. And so in simplest term, we'll talk about the 1.0 buy down. And so a 1.0 buy down would be in the first year, the mortgage would be 1% lower. And then after that, it's at the normal rate for the rest of the term. And so if you keep it for a full 30 years, it'll be for a 30-year term or until you refinance it. Now, there are different types of buy downs. There are seller paid buy downs and there are lender paid buy downs. A seller paid buy down is done through a seller concession. And so by a seller concession, what happens is that you have to basically there's a side account within the mortgage statement, and that side account will actually fund that rate differential. So say that rate differential is a 1% difference, and that deferred interest is, say it's $3,000, whatever. You would have a seller concession for $3,000 that would actually cover that difference, and that's put into an account that's a part of the deal. A lender paid buy down is a little bit different. That is paid by the lender. And so that account, that, like I said, that separate escrow account, which is different from your property tax escrow account, that separate escrow account just for the buy down would be funded by the lender. So now that I've explained all this, is it a good idea? And the answer is maybe and maybe not. It depends on your scenario, because like anything in the mortgage industry, there is never a right or a wrong answer. And so please don't listen to people that say you always have to do it a certain way. It drives me nuts when any sort of financial person, whether it's mortgage or anything else, says you have to do things a certain way, whatever that decision is, because it's always very individual. And if you ever talk to me, you'll find out I give very individualized advice based on people's situation, because that's the way any good financial advice should be. So first of all, one of the things you should know is that if you do refinance that, what happens to the buy down funds? If that escrow account is still funded on that temporary rate buy down, so say you do a 1-year buy down, but you refinance it in 6 months, there'll be money left in that buy down account. The great thing about the temporary buy down is those funds would be refunded to you as a credit at the refinance, or when they do the payoff, I should say. And that's why I like the temporary buy down a lot more than the permanent buy down. Because the problem with the permanent buy down is you're putting that money in there, but if you refinance it 6 months or a year later, the buy down money is not refundable, and oftentimes you end up spending way more money than what you saved. If you're paying $3,000 or $4,000 or $5,000 to buy down the rate on a permanent buy down, and you're paying that up front, but you refi in 6 months, you didn't save anything. You actually lost money. And so definitely in the temporary buy down, I like it because, like I said, it is refunded to the buyer if you refinance it during that buy down period. Now, there are downsides. Like anything in the mortgage industry, there are downsides. And you need to consider those downsides because they are major considerations. And certainly, I'd be happy to discuss this with you, or the loan officer should discuss this with you before you consider this program. The first one is that after the rate expires, well, first of all, before I talk about that, for qualifying purposes, that will be based on the higher interest rate. So basically, what they do is say your buy down, say the par rate, just for the sake of example, 6.5. Like I said, rates could be higher, rates could be lower. Say the par rate after the buy down expires 6.5, and you do a 1.0 buy down, which would be a 5.5% rate for that first year. Well, for qualifying purposes, we will use the 6.5, the higher, fully amortized rate to qualify you. And that's because we don't want you to be upside down in a house. We don't want you to be buying things you can't afford. What a crazy idea. You actually can afford the payment. And that's been very, very different. 15, 20 years ago, they would use these buy downs as a way to get people in houses they couldn't afford and qualify people they shouldn't be qualified for. And that's how we got in a lot of trouble. So I'm glad that, mortgage companies have gotten to their senses and said, well, gee, why don't we actually get people houses they can actually afford? What a crazy, crazy, crazy idea, right? Another thing to consider is after the payment will be higher when it expires. I mean, you've got this teaser rate, and depending on your financial situation, you have to understand that a year from now, your payment will be higher. It's guaranteed because it's a temporary situation. Now, can you afford that higher payment? And that's a yes or a no. Can you afford that? You really have to consider that because, depending on your circumstance, you're very much a paycheck to paycheck person. Is that a smart idea that you get used to that lower payment and then a year from now it's higher? Now, you could refi in a year, but there's no guarantee rates will be lower. No, there's no guarantee you qualify for refi. So, I know some people will say, well, yeah, you can get this higher rate now, but just refi in a year. That's horrible advice because we have no clue what rates will be a year from now. Rates might be higher a year from now. You might not qualify a year from now. There's so many variables. So you have to come into it with that mindset that, okay, rates will be, this buy down will expire in a year for the sake of this example, and I'm prepared to make that higher payment. The other consideration is, if you're doing the seller buy down, you could use those seller concessions for other things. Most importantly, you could use that for title, appraisal, those types of things. Or you can even use it in the case of VA, you can even use it to pay off a credit card and things like that. That's a whole different video. And so oftentimes, if it's a $3,000 buy down, would you rather use that $3,000 for a buy down or use that to pay the title and appraisal and that kind of stuff and come into it with a true zero down loan? And so oftentimes if we're in that point where there's not enough concessions to do both, I'll say, instead of taking that buy down, to use that for the title and appraisal and those types of things. And that way you can have a lower cash to close. Now, in the case of lender paid buy downs, that is where the lender would actually cover that buy down. The fully amortized rate, or the rate that after that buy down expires, would be higher than it would be if you didn't take that buy down. If you just take a normal loan, didn't do the buy down, your payment a year from now after the buy down would be higher than it would have been if you had declined the buy down to start with. So again, it's one of those things. Okay, which do you want? Do you want to have the stability of having the same payment every year, or do you want the flexibility of having a lower payment in the short term? And again, it depends on your financial situation. So who are these buy downs good for? Now, where I really started telling people they should do these is if you're expecting a pay increase in the following year. So for example, I'm working with someone right now that they're a journeyman apprentice. I believe he's a plumber, a union person, and they get a raise every year. They get a pretty significant raise every year based on experience, and he is pretty much guaranteed. Like those type of situations are great for buy downs. Somebody working on commission where they know they're gonna get higher commissions next year, or any sort of internship, or maybe they graduate from the internship, they know they're going to get a better paying job a year or two from now, they know their income's going to go up. Great for these kind of scenarios. For someone that has a job, they're only going to get a 2 or 3% increase next year, I would just say decline the buy down, especially if you're a paycheck to paycheck type person. That might be much more of a situation where you're going to decline the buy down because you don't want to put yourself in a bind where you mess up your budget. So that's a little bit about temporary rate buy downs. I know I went pretty quickly in this video. There's a lot to unpack here. Special thanks to my coworker Major Singleton for talking about this on our recent corporate conference call. Yeah, because it is a very, very important topic. Now, it's always having questions about home loans, VA mortgages, or anything else mortgage specific, or just want to talk to me, feel free to give me a call. My number is 937-572-3713. Oxford Reach at scarpero.com. Talk to you soon. Bye.